Three business valuation methods all entrepreneurs should know. If you do your research, you can do some Googling, you can look around the web, and you're going to find pretty much the same thing I'm going to tell you, with perhaps a little bit difference in terms of my own variation on the themes, which of course I mentioned in the write-up. The two broad categories of valuation methods are either market-based or market value-based or asset-based. And then within the asset-based world, we have two sort of subdivisions of that, which are liquidation and going concern, right? Those are both asset-based valuation methods. One looks at what's going to happen when we're done and we're just liquidating the business and what's the business worth. The other one, the going concern method, assumes that the plan is to continue and we're selling to somebody or having somebody invest in our business, and that's the method that we're using in that case. The reality is you're probably going to use a combination of these methods, and what I like to look at, which I call ROI based. And this method that I'm going to show you as we have a look at my screen in a minute is largely based on the show The Shark Tank. Now, if you've ever watched the show Shark Tank, what's the first thing these contestants do when they come on the show? The very first thing they all do is they start out by saying how much money they're looking for by way of an investment and what percentage of their business they're willing to give away in exchange for that amount of money. Well, if you do the math, you can quickly gross that up to 100% to get the full business valuation that they're asking. And the first thing you'll notice the sharks do every time at this very beginning part of the presentation is they start writing on their pads. Now, I can only assume that what they're doing is they're writing up the valuation. The math on this is simple. You simply take the amount that they're asking for divided by the percentage, and that grosses the dollar amount up to what 100% of that business is presumably worth according to what they're saying. Now, the rest of their job for the rest of their time on the show is going to be to convince the sharks of that valuation. And to me, that's what it really comes down to at the end of the day. Valuation is subjective. And at the end of the day, especially if your situation is one where you're looking for somebody to invest in your business or purchase it, then it's going to come down to a negotiation. And that's all there is to it. There's no one concrete formula that says, here's how you value a business. It's ultimately convincing an investor, for example, that they're going to get the right ROI. And that's why I like to use my own ROI method of valuing a business. And there's going to be a few caveats to this. Let's take a look at my screen. This template, of course, is going to be available to you. It's linked up in the write-up. So if you're watching this on YouTube, of course, don't forget to subscribe on YouTube, but then click over to our website at fundera.com/blog, and you can access this template. Just click File, make a copy. It's done in Google Sheets, and once you do that, it will make a copy into your own Google Drive folder where you can have full access to a completely editable version of this document. So, using the Shark Tank example, let's say we're looking for $250,000, and we're willing to give away 25% of our business in exchange for that, right? That valuation then is $1 million. $250,000 divided by 25%, or the math again on this is pretty simple. Just multiply it by 4 because that's how you get from 25% to 100%. $250,000 valuation for 25% ownership equals $1 million at 100%. Now let's go click over to the next piece. Now here's how you sort of sell it on the ROI. I've created a very simplified version of a model here. So you have to start by putting in whatever you think your current monthly sales are. And hopefully it's not really as subjective as what you think. Hopefully you have accounting software somewhere that can tell you. And this assumes, of course, that your business is already a business. If you're a startup, then you have to estimate what your sales are going to be in month one and when that first month will be. So I put in the space here and I said, let's assume, especially considering we're asking for $250,000 and valuing our business at $1 million, we'd better be doing at least $1 million annually. This comes out to something actually slightly less than that. And again, this is very rough. We're putting in an assumption that the monthly growth rate is going to be based on 5%. So once I put in this number, everything else is calculated from there based on an increase of 5% over the previous month. And that, of course, gets us our total revenue here. Then we have to put in an assumption about what we think our cost of goods sold percentage is, and the model will figure that out, and from there we'll derive the gross profit. Then we also put in an assumption about what percentage of the gross profit goes out to overhead. So right now I put in a simple 50%, which means we're going to have net income of 50% of that, the difference, of course. Next, we take that and we look at net income on a cumulative basis, and here's where the ROI part comes in. Over here on my left, we bring over from the previous tab what the investment was, what the percentage was, and based on that, we're going to start to accumulate what the shark or the investor's share of this deal is going to look like. What are they going to get back? What's their return on investment? As we go to the right, and based on all the assumptions we've set in place above, we're going to look out and see where does this become a positive ROI? How long does it take them to recoup their investment? And in this scenario, it takes until April of 2019 for them to go over 100%, for them to cross over that point where they've gotten back their $250,000 investment. From thereafter, it's all uphill, and the percentage, the ROI, keeps increasing. Now, is this good? Is this attractive to an investor? Very, very subjective. It depends on the industry. You want to try and compare your business to other businesses in your industry to see how you would fare against them, especially in a scenario like this. And there are a few more caveats that I feel are important to mention here. So one of the things, if you watch the show Shark Tank, and you might have picked up by now on the fact that I do, I love the show. And one thing you'll notice that they don't want to see is, because this scenario might look awesome until you start looking at your balance sheet, and hopefully you've already seen the post I did a while back here on the Fundera Ledger about the balance sheet. If I'm an investor and I'm looking at a business with this kind of a model in this scenario that maybe looks really good, based on that kind of ROI, the next thing I'm going to want to know, though, is what does the balance sheet look like? Are you carrying a lot of debt on the books? Because if you are, then I'm not ever going to see this payout on my share of the net income, am I? Because you're going to be busy using that money. In other words, you're going to be busy very likely using the money I've invested in your company to pay off other debt that you've incurred elsewhere. And if you notice, the sharks, whenever somebody comes on and admits that they've got a lot of debt on their books, the sharks are pretty much all out. So if you do have a lot of debt on your books and you're looking to get an investment like this, you'd better be prepared to also show them in your financial model how you're going to settle that debt out of your own share. The last thing an investor wants to think is that you're raising money from them to pay off debt that you've borrowed from somebody else. They want to know that the money they're investing in your company is going to be used to grow that company and get them the return that they're looking for. So things to consider. You have to look at the whole picture. That model is by no means complete. It's just a simplification to give you an idea. And so in your own case, if you're looking at something like this, you could play around with scenarios to see ultimately what percentage and what amount being invested might look attractive to your investors. Let's go back to the screen for a second and I'll show you what I mean. Let's say we decide that this isn't really an accurate scenario, that the cost of goods sold percentage is much higher. Let's say it's 65%, and that, and I guess I have to remember to put it in properly as a percentage. So if we assume it's 65% cost of goods sold, gross profit 35%, and my expenses, let's say, are more like 75% of that, then that's going to change things. It was April of 2019 before. Now it's going to take a lot longer for them to recoup their investment. Again, good or bad, hard to say. Depends on the industry, and it depends on what's going on in the world of your business. But the point is, I can look at this and let's say I don't think this is going to be attractive to my investors. Then what I can do is I can go back to my valuation tab and do one of two things: either lower the amount of investment that I need or increase the percentage, or both. And what the right strategy is there really is going to depend on what you're looking to do. A lot of people who come on Shark Tank don't really care about the money. It's not the money they're looking for. They're looking for the partnership. They're looking for the experience that these sharks have, because it seems to me, at least, that any of these sharks can make any business a tremendous success just because of who they are and the connections, not to mention all the experience that they all have. So, it might be that you're willing to say, you know what, I'll take less money and still give away 25%. Because if I go back to my screen here and say 125,000, right, I'm knocking it in half, which means I'm having the valuation. But at the end of the day, I don't know that I really care what I'm saying the valuation is. I'm much more interested in making this look attractive to the investor so that they'll want to invest the money. And in this scenario, now they recoup their investment as early as November of 2019. And if I change that back to 250, let's see what the difference is. Now instead of November 2019, it's November 2020. It makes the difference of exactly a year at that rate. So again, you want to play around with these assumptions. You want to play around with these scenarios to try and put your deal together in such a way that's going to make it look the most attractive possible to the investor, who ultimately cares about one thing in the end. I mean, yeah, they've got to like the product, they've got to like the idea, but at the end of the day, before a shark is going to put their hard-earned money into your business, they need to feel confident that they're going to see the ROI, or the return on their investment. Or you get somebody like Mr. Wonderful, who's going to want royalties and not even a percentage of your business, and you every time see why the other sharks say it's just a really bad idea. I'm not going to get into my opinions about that. I don't have the experience that Mr. Wonderful does. But nonetheless, hopefully this gives you an idea of how to approach business valuation from an ROI perspective, keeping in mind that you have to be able to also look at this from all sides, which means going back to the previous posts that I've published here on the Fundera Ledger, we have to understand the profit and loss, which is what we've summarized in this model, but we also better understand the balance sheet and the statement of cash flows and how all of that plays in. In the end, you'd probably be wise to hire a business broker to help you with the valuation of your business, and also probably wise to hire an accountant or some financial professional who can help you put together the financial model so that you really have a good understanding of your numbers going into any negotiation. And that's what it's going to be at the end of the day. Like I said in the beginning, it's going to be a negotiation between you and the person who might potentially invest in your business about what that business valuation actually is. As always, I hope you had some fun and learned something along the way here. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.